Welcome back, insiders. Now, I don't know if you've noticed, but there's a lot of doom and gloom in the news lately. Top stories including billionaires selling stocks, the majority of US cities are bankrupt, national debt spiraling, and overextended markets. The worst part is this is reality. This is actually what's happening. And in this video, I'm going to be sharing two indicators that insiders are watching, which typically are precursors for when our beloved S&P 500 tanks at least over 20%. So even if you don't care about timing the market, at least you can prep and know the signs for the incoming bear market. Now, first of all, I did actually want to start off with something for all the home buyers out there. This is actually a study that came out from the Federal Reserve Bank of New York. And if you scroll down, this is kind of interesting. 67.1% of all respondents characterized buying property in their zip code as a very good or somewhat good investment, slightly below the last 3 years, but still showing optimism. Now, the share of respondents reporting that housing is a bad or somewhat bad investment increased to 9.1% from 7.9% a year ago. So more people do feel like it's a bad investment, which kind of makes sense. Home prices are pretty absurd, and it does feel like there's more downside than upside potential. And this point really hits home in this survey down here when they say renters' perceptions about ease of obtaining a mortgage deteriorated substantially, as 74.2% stated that obtaining a mortgage is somewhat or very difficult. This makes sense because interest rates are still very high and the median price of a home is still approaching $500,000. They go on by saying this represents an 8.4 percentage point increase from last year, so it's getting more pessimistic and well above 2021 low of 50.5. That's a pretty big amount of pessimism in terms of obtaining a mortgage. Furthermore, renters' self-assessed probability of ever owning a home decreased 4.3% to a new all-time low of 40.1%. So people still believe in the dream of owning a home and the value it creates. However, they don't believe it's a very possible dream. Now, what's going on with interest rates? Because they are still pretty high. And you could see across the board from several different countries, most interest rates are going up. However, predictions are estimating that in Q1 and Q2 2025, we'll start seeing a dip in interest rates. And this is actually something that the Fed reiterated in their more dovish stance in their recent FOMC meeting, which we'll talk about in a second. But first, I just want to go back to the basics and review what is dovish. Remember, monetary policy decisions are made by the Federal Reserve, which can take a hawkish or dovish stance based on its goals. Hawkish monetary policy focuses on low inflation and may involve raising interest rates. Right now, we still have a higher inflation, which makes sense, roughly 4.5%, while the target is typically around 2% down here. That's where we want to get to. So that's why, in general, right now, we are more hawkish. But in the last meeting, they showed dovishness, which again makes sense as we are getting more dovish from this overall hawkish area. Dovish policy prioritizes low unemployment and may involve lowering rates. Lower rates, better economy, better employment. The problem is inflation was not fully transitory. We didn't go up and then right back down again. It was somewhat sticky, resulting in stagflation, which we are stuck in right here. If we lower interest rates, then the market will boom more, and that causes more inflation, which directly widens the inequality gap. I'll save the relation between inflation and the widening inequality gap for another video, but in essence, it's because prices increase, which means the average consumer has a higher burden, and wealthy people, which typically have their money in equities, they see their assets increasing. Now, everything's determined by the Fed, spearheaded by our boy JP, which I'm sure you guys all know, but I wanted to give a little bit insight of this FOMC, the Federal Open Market Committee, which has meetings about 8 times a year, at least scheduled meetings. Every now and then, they also have unscheduled meetings. Anyway, these are 2-day long meetings, 8 hours total, so 4 hours each day. And typically the first day is all about presentation and discussion of economic and financial conditions, which include data on employment, or rather unemployment, inflation and other key economic indicators, which we're going to cover in this video. The second day is policy decision and strategy formulation. This is basically what we're going to do based on the day one presentations. Now, the next meeting we're going to have in June, roughly in 6 weeks, but the last meeting, which happened roughly a week ago, there's a lot to read about it. But in general, they think everything is getting slightly better. They're more dovish. And they did really highlight the fact that equities are just booming right now, but specifically large cap tech companies, which is important to note. We're going to come back to that point in a second. The Fed also predicted that they want to do 3 quarter-point cuts by the end of the year, which would start putting this curve going down. However, many economists are not expecting any rate cuts until 2025, and that's a little bit like what we're seeing here on this long-term interest rates forecast, where you don't see a budge till Q1 or Q2 2025. Now, people are worried about the Fed making overcorrections, which is typically what happens, or the chart wouldn't look as chaotic as this. But keep in mind, with a booming market, there's no need to lower interest rates. Plus, interest rates are already high, and big tech companies are cutting a lot of their staff already. And the effects of interest rates do take a long time to see the effect. Now, most people are still bullish because the earnings report that we saw recently are looking pretty good. And I think a big reason for that is if you go to the unemployment numbers, they're still really low. So the consumer is still really strong. But here is exactly what a lot of people are worried about. And this is the small uptick you're seeing right here in unemployment, which does line up to the white collar crisis we're seeing a little bit. So tech is firing off a lot of employees. Obviously, there is the AI discussion to be having, making tech companies more efficient. But if the S&P 500 is totally propped up with tech companies, which are now laying off employees, which is going to hurt the unemployment rate, it's a bit of a vicious cycle. Now, here are the two things that typically always happen before a S&P 500 sell-off, or I guess you can say a recession. It's whenever there's a pivot in one of these charts, if it's the Fed funds rate or the unemployment rate. And I'll show you guys exactly that right here. So the orange line is the S&P 500. And without going back too far, you can see every time there was an inverse in the interest rates. So here the interest rates went up, and then we decided to crush them because the market needed help because of the dot-com bubble. So we reduced interest rates, and the S&P 500 went down for pretty aggressive sell-off, around 48%. Then interest rates started to climb again. This time the housing crisis happened, so we had to lower interest rates to revive the economy, which the S&P had a big sell-off, around 50%. Then again, we had a slow increase here of interest rates getting higher and higher and higher. And then we started moving interest rates lower again, which resulted in a roughly 20% decline. So right now we're in a little bit of one of these situations where if interest rates start going down again, it basically means the Fed thinks it needs to stimulate the economy and the S&P will follow. Now, unemployment rate has a similar fate. If we go back to the charts, you'll see that when unemployment starts creeping higher again, the S&P typically is going down. Here we have that perfect example. And then here again, when we start breaking a new high, the S&P drops again. Here, new high, big S&P drop. Now this is COVID. It's a little bit of a unique scenario. And then here we're getting a new high for the first time. The S&P is dipping a little bit, but it's still looking pretty bullish overall. So the question is, how much further are we going to go? Because if unemployment starts going up, specifically past this 4% line, a lot of people are going to take note. Mark my words, there's going to be a lot of very bearish news articles coming down on that break of 4% unemployment. Let me know in the comments below, at what unemployment percentage rate would you start getting worried? So if it's the Fed funds rate that sees a pivot going lower, or if it's the unemployment rate getting a pivot and going higher again, I would be very worried about the S&P 500. Right now, there's probably no reason to panic, and I wouldn't be surprised if we saw some new all-time highs on the S&P 500. But I definitely understand why billionaires are selling and taking their profits, because the market is high, and it feels like there's a lot more downside potential than upside. Remember, guys, there's always Bitcoin, which looks to be back in the mid-range of its bull flag. I myself am long, and I don't plan on selling anytime soon before we see 6 digits. digits. Thanks for tuning in, guys, subscribing, and dropping that like. I'll see you next time.